Leah's being very kind to me in her introduction. I know how to get fired very easily. If any of you all want to learn how, just ask me. And I want to also protest that Rocky's here. He asks all sorts of hard questions, and this is no fair. Some of you, I would also say Happy Valentine's Day to you. Some of you will go out and have a fancy dinner tonight with all your wives or lady friends. I bring my wife with me to financial analyst meetings like this, so that's about as good as it gets, perhaps. Be that as it may, let me put these away. You know, you all have heard from some very good and wise speakers today, and I'm sorry we missed some of them. Lacey Hunt and I went to school together many moons ago, but now apparently you have to be punished. And by listening to a hardened sinner like me, as Leah said, I spent 35 years as a sell-side analyst with all the usual suspects. Couldn't hold a steady job most of the time, and then ran energy hedge funds down in Houston for the last 8 or so years. And along the way, though, I learned an awful lot about the markets, how they work and how they don't work, and how much of a revolution we've had in the last 15 years. I really learned the hard way, I must say. And I want to share some of those insights with you today. I'm going to use my energy background to give you sort of a frontline view of just how things have changed, how the market landscape has changed, really. And in my opinion, really not for the better. So I'm going to cover the energy waterfront when it comes to trading and correlations. I'm going to talk about accounting and valuations that come out of them. Some about corporate governance. There's never a dull moment in the oil and gas business, those of you who have been around it, because the business is very much a target-rich environment. All sorts of things can and have happened. All I do is read the Wall Street Journal every day about someone either going to jail or whatever. And a lot of these things that have happened have not been good for the stockholders. And we on Wall Street have been very accommodating, I must say. And this may eventually lead to our own undoing. The existential issue for all of us, and I emphasize this, is active versus passive management. Active versus indexing, because what's happened, the trend is not our friend. Over the last 12 or 13, going on 14 years now, the amount of equity products that have gone to indexing has gone from 21% to about 35%. So it keeps on edging up and up and up. People get tired of all the volatility and the noise and so forth. What has been happening in the last 5 years? The benchmark S&P 500 index has gone up 17.9%, call it 18% a year. Well, a wonderful recovery from March of 09 levels. The average U.S. equity mutual fund has gone up almost as much, about 17.7%. Long-short equity hedge funds have done poorly, about half, typically the upside of the S&P 500 or less. They're up about 4 to 5% a year. They simply don't work under regulation NMS, the national market system, and all that's been going on since mid-2007. In 2013 alone, the S&P was up 32.4%. Mutual funds, the average equity mutual fund was up almost as much again. Hedge funds are up 14.4%. Equity hedge funds, again, about half as well. Or half as good. But costs and overheads can be decisive. The SPDR, the SPY, costs the owner 9 basis points, and that's just using a robot fund there. ETFs, exchange traded funds, will run 40 basis points. Mutual funds will run anywhere from 50 to 200. Hedge funds, 1.5 to 1% is now kind of the average. Indeed, hedge funds in the year to date, 2013, the management fees come down to a little less than 1.4% and about 17% incentive fees. George Soros made $5.5 billion last year running a very high-cost operation in New York City. Wonderful move and the like. He made 28%. If you just put it all into an index fund, an SPY, he would have made 32.4% or so. That's the problem right there. Now, whether you're on the buy side or the sell side, the changes in the past 15 years have just been simply amazing. When you step back and think of what has happened, how we have evolved with everything from really the 1997-98 years, it's been good for selected players. There have been definite winners and definite losers. You don't want to be Knight Capital, which in August of 2012 lost about $10 million a minute for 45 minutes, because of a bad execution algo problem there. 45 years ago, when I got in the business, after I got out of the service, a trade on General Motors cost you 45 cents a share, whether it's retail or institutional. Today, that's the average commission is going to run a little over 2 cents a share. If you're part of the 110 to 120 hedge funds in Dallas and Fort Worth, it's about a penny a share. So the economics do not get to be very good here. Today, the lit volumes, as they're called, or lighted volumes that you see are 4.5 billion shares a day, instead of 20 million shares 45 years ago. And you don't see about 35% of all the volumes that are traded because they're dark. They're either internal pool, where people are crossing internally and marking up the product.
Can you speak up?
Oh, sure.
It's very hard to hear you.
Okay, let me get closer to the microphone here. But there are easily another 2 or 3 billion shares a day you never see get printed. The largest is Crossfinder, which is Credit Suisse, and that runs about 1 billion shares a day, but they don't publish that. So we get what we pay for. In my opinion, where I came from, in terms of research, it's not what it used to be. And research is supposed to be about 60 to 70% of all of brokerage commissions. So according to the understandings with the SEC, it usually is not. Commissions have come down $5 billion from about 14 or 15 billion down to about 10 in the last few years. They hopefully have recovered about $1 billion last year. So I'm going to run some slides. I'm going to highlight some of our issues. I'm going to be very subjective. The numbers move around on us. So, as I say, bear with me on that front. I hope you do get some flavor here, because we have developed some very aggressive trading and accounting and valuation standards there. And they reflect ultimately on the governance and on all levels of the business, whether on the sell side or corporate managements and the like too. So let me find a deal here. And whoops. Energy is about 15% of the overall stock market. It's loaded with investing issues, as many of you are aware. There's some unfortunate correlations that have happened, and along with some superb trading profits that come along. And we've had accounting and valuation issues which have debased the currency, in my view. And I'm going to show you some energy profiles of various companies as we go along too. Whoops, I'm going the wrong way. Now, in the bad old days, just to give you an idea of an identity crisis here, when I was written up years ago because of various Enron situations, a reporter at the New York Times asked me what my children thought I looked like with all being on television so much and the like, and I told them they thought in turn that I looked like a basset hound with a 25-watt personality. Guess what shows up in the New York Times? This is not good. Scholarly Ichabod Crane in the Washington Post, my assistant's children said, no, you're all wrong, I look like Mr. Rogers. So that's what you get for that. I had a research team going along with me from various companies, Drexel to First Boston to Goldman Sachs, Merrill Lynch. And I had to review them. They came back and reviewed me. And they don't know where they dredged some of this up. It works well when under constant supervision and cornered like a rat in a trap. Then it goes on downhill from there. So, oops. And this is where I come from, the investment banking business. It's a cruel and shallow money trench, a long plastic hallway where thieves and pimps run free and good men die like dogs. There's also a negative side. That came from a retired Lehman partner and long since passed away, as it was. And here we are, value investors, I hope and trust. What do we have? Equity hedge funds, mutual funds, exchange-traded funds, corporate and government pension funds, all adding up to about $14 trillion. And then there's you. That's called a crowded trade. A lot of people trying to chase the same puppies along there. Correlations. There's everything life before NMS, life after. Before NMS, you look at the largest mutual funds out there. They're correlating with the S&P 75% of the time. Between 2009 and 2012, it became 98%, 97% of the time. Drives you a little crazy if you're a mutual fund trying to outperform the market and showing your clients that you're worthy there. These are the kind of things you can get right off the shelf. Bloomberg algorithms, hide and sweep, hide and fire, arrival price, and the like. And what they do is they're just slicing and dicing orders into 100 share round lots, 200 shares or whatever, and just go crazy that way. This is the energy industry balance sheet. And if anybody wants to talk about energy issues, specific issues about what's happening in Russia or the Sudan, whatever, I'll be glad to talk to you if you're. Let's do it later. But this is the about $1.4 trillion worth of market value right here. Generally speaking, the higher the institutional ownership in this universe, the greater the correlations have been there. Oil service companies, the leading oil service companies, 78%. If you look at the secondary oil service companies, they're 80 to 95%, in one case 100% owned by institutions there. Large MLPs, not that bad because they're mostly a retail product and so forth. Coal is now down to $20 billion worth of market cap, 90% owned by institutions. There are a lot of character building events going on in the coal business. They were down 70% last year and they're down again this year, sorry to say. The demand outlook. This is the Energy Information Administration's latest revelation of about a week ago. And here we're talking about very little growth in oil demand in the United States over the next 10 years. Natural gas demand is going up a little bit better. I suspect the numbers are somewhat conservative on the gas side, but on the oil side, indeed, we'll be lucky to get up to 19 million barrels a day, I think. All the growth, China, rest of the world there. LNG especially will be coming on liquefied natural gas on that side. This is a busy slide. This just shows you correlations. This is where I'm talking about CLA is crude prices against the S&P 500. Again, I apologize, you can't see this, but S&P 500, Occidental Petroleum, Schlumberger, the ETF for master limited partnerships and whatever. You can see it in the slides. It'll come that you can get off the internet here. This is the forward price curve for oil. This is not a pretty curve. This is severe backwardation going from $100 a barrel right now to 2022, $76 a barrel. You don't want that kind of curve out there. Now, it's a little bit crazy because there's about well over 1.5 million barrels a day of new supply coming on this year, another 1.25 million barrels a day coming on next year. Too much crude supposedly chasing too little markets. Some of this crude is world-class garbage. Kashagan on the eastern coast of the Caspian Sea was an $11 billion project when it was discovered in the year 2000. It is now a $42 billion project with not one barrel of oil produced yet. What is the problem? 15% hydrogen sulfide. You drill with gas masks, you operate with gas masks because if you breathe it, 30 seconds later you're dead, in essence. So they call Kashagan, what is it? Cash all gone is the in the international oil community right there. The break-even budget price for Saudi Arabia is $90 a barrel. The break-even in Russia is $93 a barrel. The people who make the market in crude are 5 major international traders, mostly in Geneva and Zurich and Zug and Singapore and elsewhere, Rotterdam, Gumvor you've never heard of. They're Russians, part of the Russian mafia, the Siloviki around Putin, moving 3 or 4 million barrels a day. Trafigura, Vitol moves 5 million barrels a day. They move 15 million barrels a day in the cargo markets, which are probably around 30 or 35 million barrels a day. A lot of crude moving there. So it's a dialogue between Saudi Arabia and the big cargo market traders there as to what the price of crude is going to be. And I suspect if crude gets too long, Saudi will cut back its production. This is natural gas in contango, going up and up and up. Very strong 2014 because of all the bad weather, which has afflicted most of the country. But it goes up to, in the year 2025, gets down to $5.65. Today, you need at least $6 to $7 to make any money out of the natural gas business. Oil is subsidizing natural gas, all right? Clearly, no question about it. There are maybe a handful of companies which can make money at $4 or so. That's because they capitalize a lot of interest as they go along. They're allowed to. But you need $7. This will change. Why will it change? Because the rig count is way down. It's going to take 2 or 3 years to clear the market again. LNG projects are coming on, which may be a little bit risky by that time, but because the price of gas is likely to go up. The only place you want to be in the exploration and production business is where you have people with hedges on there. So, okay, this is a correlation, if you will, or a graph of crude oil prices and the S&P 500. For years, Adam Szymanski, whom you would not know, he is now the administrator, number 3 guy at the Department of Energy. Adam would forecast crude prices by forecasting what the Standard & Poor's 500 was going to do. And why shouldn't he? I mean, it was going up and up and up. Then along comes regulation NMS. What did NMS do? It came up with a best bid, best offer, but also opened the market to what is now 44 dark pools plus 13 or 16 exchanges, depending on whose numbers you look at, and you just arbitrage everything that way. You have trading algos, as they're called, who are correlating everything, commodity trading advisors, hedge funds, prop shops, and the like, all indexing, if you will, to crude. And you can see what happened here, almost identical, until we get to mid-2012 when things start breaking apart. A very happy sign to see that breaking apart there. This is near term, just the past year. The last one went back to 2002. This is just the past 12 months, and you can see, again, the correlations breaking down, which is good for all of us in the markets there. This is Occidental Petroleum, and this goes back 10 years. You didn't need to be an analyst to invest or a portfolio manager to know what's going on at Oxy. All you had to know is what was going to happen with the price of crude, which again is a challenge. And it made a lot of people look good. From here, $20 to $147 a barrel, people look like geniuses because stock prices were going up with crude. Now, I might add, I should have gone back and mentioned earlier that the price got up to $147 a barrel in late June 2008. Why did it get there? We were in a recession since December of 2007, okay? Everything was going down fast because of the crunch in the financial markets and so forth. Crude's going up to $147 a barrel. Why did it go up? A certain individual in Tulsa, I won't mention his name, TK, the initials, was short crude in a massive way, and they found out and they just killed him. And he has avoided jail. He is, the issue is whether he owes Citigroup and the syndicate $1.2 billion or $3 billion. So that's how crude went up there. It was a big head fake. And then crude went from 147 down to hopeless levels and has since recovered. But here, from here to here, Ray Irani, the chairman of Oxy, now gone, ousted last May, he made a fortune there. He walked away with $711 million, effectively, because Ray, when he was in Houston, was known as an excellent petrochemical engineer and as a great bridge player. Just being in the right place at the right time. You can say this about some of the other CEOs in the business too. Crude versus Schlumberger, the correlations, you don't need an analyst to tell you what's going to happen here if crude's going up. That's breaking down a little bit over there. Crude versus Anadarko Petroleum, breaking up a little bit, but before that you have, again, very strong correlations going on there. This is crude versus Seadrill, the best offshore drilling company by far. I won't go into it, I'll just show you, again, the correlations are breaking up a little bit. Now we're going to talk about some accounting and valuations. Rational irrationality here. A situation in which each influential actor does only what makes perfect sense from an individual perspective, but the combined effect of everyone's acting in this way leads to outcomes that make sense for no one. Dogs fighting over the same bone. Too many people chasing too few good deals out there. The new investing hegemony, you have value investors, momentum traders, quants, dominant strategy, high frequency trading. Typically now 50% of all trading on all exchanges. This is a little dated, 10,000 trades a second. On the NASDAQ OMX data feed, they've done 47,000 trades a second. It gets a little fast there. It's moving at warp speed there. Access at 300 microseconds. They've just developed technology where you can do it in 60 microseconds there. Phony volumes, NASDAQ they went out and ran tracers with all this what's called spoofing that goes on looking for suckers out there in the markets. They did 1.2 billion shares one day a year ago, January, of actual trading volume. They had messages of over 91 billion shares in a day. So, and getting worse, global expansion. A lot of these firms, prop shops now, and the like, are running global trading books. They do 24-hour books. They go to New York, to London, to Hong Kong, to San Francisco, and pick off, Sao Paulo and South Africa and Oslo along the way. Through prop shops. These prop shops used to be at Goldman and Morgan Stanley, whatever. Because of the Volcker rule, they're being forced to divest them out of the commercial banking system. Where have they moved? They've gone to BlackRock, they've gone to KKR, they've gone to Blackstone, they've set up their own shops and the like. They want to make 10 basis points or 1/10 of a cent a share. That's the goal. These people are what you are called in Yiddish schmatomeisters. They're rag dealers. They're scalpers, in effect. And half the volume that's moving on these exchanges, not so much the New York Stock Exchange, but all the dark pools, this is where it's all going. On the basic order entries on the New York Stock Exchange, there are 12 of them. Buy, sell, limit, up, down, whatever. On BATS Direct Edge, as it's called, there are over 2,000 kinds of order entries that you can do. Drives you a little crazy there. Except now these guys are not making 1/10 of a cent a share, they're making 1/20 of a cent a share at best. And hopefully they will just compete themselves into something worse here. The trading challenge, I won't spend too much time on this right there. We have balkanized the business. We have tremendous excess capacity in trading. Goldman can do 4 times the amount of volume that on its computers. I was reading just the other day, Goldman now has 8,600 people in technology and risk management out of 32,000 employees. When I was there were 9,000 people total in the company there. Current trading profile, high frequency, about 50%. It's sort of leveled off. The indexing is 25%, traditional value investing about 25%. All you see is 66% of the volume. Dark pools, internal crosses and the like are the other 34% there. Profitability, depending on whose numbers you look at. This is pure stat arb, where the people are just doing massive high-frequency trading. Other people, Tab Group, would tell you they actually made over $8 billion in 2008. Citadel in 2008, when the market was falling apart, in high-frequency trading, made about $1.15 billion alone. But 4.9 down to about $1.2 billion is kind of the generally accepted practice there. Wrong way. There. None of you have heard of Virtu Financial. You will. It's just a matter of time. Virtu started going on 6 years ago. It's doing now 5% of all equity trading volume. It does 10% of Microsoft's average daily volume. It trades in 205 venues now with 150 people. They filed an IPO in December of last year. Never lost money on any day. There are a lot of people like that who have never lost money on any day. They end every day flat, just out of the market, made their 0.1% a share on a volume and whatever there. Latest 12 months EBITDA, $274 million of $415 million of net revenues. Net income is earning up 11% through September of last year. Vinny Viola is the guy behind this. He was the chairman of the New York Mercantile Exchange between 2001 and 2004 and hooked up with some algo traders. And they set up this. He owns 70% of it. He just bought the Florida Panthers from Miami. It's a hockey team in Miami for $250 million. He just put his house on the market on 5th and 69th Streets for $114 million. So let's say he's not hurting, okay? There. Defining deviancy down to describe how society lowers the threshold of acceptable behavior rather than face up to troublesome moral declines. I think the accounting business, Financial Accounting Standards Board in particular, has to plead guilty on all counts right here. What we've done is shorten the playing field and lowered the goalpost with a lot of things, whether it's goodwill accounting or mark-to-market accounting and whatever. On Wall Street, if you torture the data long enough, numbers will confess to anything. I've seen it happen time and again here. Here's a sad statement, as far as I'm concerned, from the retired chairman of Deloitte & Touche. The accounting community produces financial statements almost completely irrelevant to financial analysis as currently conducted. The analyst community does workarounds based on numbers that have very little to do with the financial statements. Net income is a virtually useless number. That's a very sad commentary on all of us. The more earnings you have, the more of everything else you have. The more cash flow, more EBITDA, more blah, 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 whatever you want. But on Wall Street, if you don't have the earnings, you invent something else there. And it generally is accepted there. SEC Regulation G. This is interesting. Get out of jail free as far as I'm concerned. Because of Sarbox, the SEC had to come up with something. This allows you to show generally accepted accounting results against what you think you really did, ignoring all sorts of unusual items, what the normal, platonic, ideal earnings stream was right there. Now, to give you an example, I'm sure all of you are the world-leading experts on Twitter. In the fourth quarter, Twitter had revenues of $243 million. It lost $540 million. If you believe their Regulation G, their non-GAAP numbers, they actually made $10 million and made 2 cents a share. Going from losing 511 to making 10 or $11 million is quite a leap. Next year, they're going to, and they had about $600 million of stock compensation expense for their employees and the like, cashing in. They're going to have another 600 to 650 million next year. Again, things defy the law of gravity. I'm too old and too stupid to explain just why this is, rather radical departure from double entry bookkeeping as I grew up with here. There. You can, fair value, get rid of fair value items, stock compensation expense, acquisition expense, restructuring costs. IBM took $1 billion of restructuring charges and hurt their earnings, intangible amortization, and so forth. It's a very, very messy idea, but it has allowed people to think, idealistically about what we have as sort of celebrity valuation. It's just like we have celebrity justice and whatever there. What is EBITDA? Earnings before interest, taxes, depreciation, amortization, or earnings before I trick the dumb auditor. EBITDA is a nice metric for bond people in particular. I can't tell you anything about the profitability of a company by looking at its EBITDA. We used to call it trash flow as opposed to cash flow, nor how well management is executing in the process there. So again, I'm very skeptical about that. This is basically a one-slide rendition of Graham and Dodd, as kosher as you can be. What does the S&P 500 look like right now? Forward earnings forecast 15.5 times. What kind of yield? What kind of payout ratio? That payout ratio of 32% historically was 42%. And people like Exxon, for instance, are buying in stock, which is, for Exxon, it works because they have nothing else to do with their money, apparently nothing better to do. The last acquisition they did was $39 billion and was a disaster, called XTO Energy. For them, a disaster because they bought it without realizing the hedges were going to disappear. Return on equity, 15.3%, with leverage of 50%. Net leverage, really, because they have so much cash in the S&P 500 companies, about 33%. So that's my benchmark, at least. How much, what kind of price earnings ratio is going to buy me what kind of growth rate, which typically is about 6% a year. What kind of yield and profitability, return on equity, and related capital structure there. What do we have in the oil industry? This is something I looked at when our hedge funds were running. I took a sample of a week's research reports that came in my inbox. I get 23 different ways to value a company. I would submit there are not 23 ways to value a company. Correct me if I'm wrong here. Earnings, adjusted earnings, all sorts of cash flow adjustments, free cash flow yield, breakup values, pre-tax asset values, theoretical fair values. And if you get into Canadian companies or Australian companies, you get a whole different universe. I mean, it's like Planet Australia and Planet Canada right there. I would argue that you should be driven by the good old-fashioned earnings and profitability and yield and the like there. This is Enron. You want to know about creative accounting? They reported in the year 2000. They couldn't do the 2001 books because it was a disaster. They reported $1 billion of profit with mark-to-market and mark-to-model accounting. The actual cash or accrual accounting was $42 million. They reported cash flow of $3 billion. It was a negative $154 million there. They were doing deals like this. This is called a repackaged asset vehicle, a RAV. It was a stupid deal, totally stupid deal. It was predicated, the CFO and some of his cohorts were predicating this on Enron's stock price going up at 40% a year forever. It really was a hedge on a little company called Rhythms Net Connection, which was supposed to trade, came out as an IPO over on 25 and went to 120 back in the 97, 98, 99 craze days. They tried to hedge it. At the same time, the CFO took, and three commercial bankers took right out of the LP about $32 million. That's why he went to jail for 6 years, and so these other people too, the bank officers. Invented tradition. Elites help create mythologies and rituals that bring people together under a common set of beliefs, and more to the point, under the authority of those elites. This is Wall Street telling you what to do. You read these research reports, you look at prospectuses and everything else, and people will say, oh, let's use EBITDA, or let's use enterprise values, sum of the parts valuations, and the like too. And we continue to debase the currency that way. Here's something, a very smart girl, very bright girl, who is the exploration and production analyst at Deutsche Bank, coming up with her way of valuation. I've been doing this all my career. I don't understand what she's saying. And she, as I say, is smart, lovely, and whatever, and 42 years old. She had a stroke with 3 children. It is now no longer in the business, but I think trying to come up with these kind of calculations probably didn't help there. If you ever sit down in a poker game and after 15 minutes you haven't figured out who the pigeon is, you're the pigeon, all right? And this is the kind of games we're playing with correlations and trading and accounting and valuations there. Let me spend, I won't spend too much time on this. I'm going to run out of time anyway. Let me just talk about a few of these companies in passing because, again, institutions have turned the other cheek, saying, hit me again. In some of these cases, in other cases, down at the bottom, Seadrill and OneOak, which I happen to own, I must say in full disclosure, they take care of their stockholders, all right? They take care of them in a rather wonderful way. Weatherford, for instance, this is a company in the last 3 years, the company's stock price has gone from 27 to 14. At the same time, they paid the CEO about $40 to $45 million as a reward for all this. What has he done? He's moved the company to Switzerland. He's run off with a beautiful Russian woman and is living happily ever after over there. They did business in places, these wonderful politically correct places like Syria, Iran, Cuba, whatever. They had to pay over $100 million of litigation expense, and they just paid under the Foreign Corrupt Practices Act $153 million. They didn't know what their tax position was for the last 4 years now. They finally figured it out. Couldn't file a 10K over that time frame. They ran through 4 or 5 CFOs in the process. And now they are sort of coming home to Jesus by saying that they're going to take a $15 billion a year revenue company, and that's, they have about $3.5 to $5 billion of revenues, which really don't count, so they're going to try and get rid of them or lose them somehow. So, stay tuned right there. McMoran Exploration. This will maybe curl your hair there. McMoran Exploration was a little E&P company that was spun out of Freeport McMoran, the old Freeport Sulfur Company, and McMoran Oil and Gas, years and years ago, and it became kind of a adventure in drilling ultra deep wells in the Gulf of Mexico, 30,000 feet or so, to find deeper horizons out there. The last 10 years, they lost the stockholders $1.2 billion. They gave the top 2 guys in the company, who happened to be the top 2 guys in Freeport McMoran, $81 million of options to lose us $1.25 billion. Okay? Now, Freeport McMoran Oil and Gas is losing all this money, $150, $200 million a year. They ran out of people to finance the company, so for the parent company and advance the money. Then the parent company finally had to decide to take the company over. There was no choice. They paid $3.4 billion for the assets of this company. They got a fairness opinion saying it was worth 14 3/4 when the stock was trading at 8. They gave a little warrant which suggests that if they ever found some oil and gas, really natural gas, at 30,000 feet down, they would this warrant would ride along with the production out there. The trouble is they've had these wells trying to complete them for the last several years. Of that $2.7 billion of assets, 2 wells have $1.2 billion invested in them. Now, I can drill a well a little bit west of here for $3, $5, $6 million, a no-brainer in the Barnett Shale or whatever, and live happily ever after. 2 wells, $1.2 billion, 40% of the company's assets in 2 wells. And they've never been able to complete them because of the temperature, pressure, and everything else problems that you have there. Maybe they will, maybe they won't. So, at the same time, their production has fallen 50% over the last 5 years. The reserves are down about the same. They're producing their oil and gas at about $7.50 per MCF equivalent, as it's called, except it costs them $11 to produce it. The more they produce, the more they lose. All right, doesn't make any sense. So what do? They pay 14 3/4 to take the company out, $3.4 billion for this beauty. And when they they folded it in, and they also folded in a company called Plains Exploration and Production to make the matters to sort of calm things down or subsidize this effort. And they collected, the two principals collected about $63 million on their options. The parent company, Freeport-McMoRan, made $123 million gain on the transaction. The chairman and CEO of Plains Exploration made $147 million from his change of control deal. And they all lived happily ever after. What happened to the Freeport stockholders? Guess what happened? They got the gold mine, the stockholders got the shaft, in effect, there. So, Keynes, very smart investor, lost his shirt 3 times in a row, but ended up making a killing there. But I think there's a lot in what he said back in 1930. It's not a case of this, a beauty contest he's alluding to as a metaphor. It's not a case of choosing what's the best of one's judgment, or really the prettiest, nor even those which average opinion generally thinks the prettiest. We've reached the 3rd degree where we devote our intelligence to anticipating what average opinion expects the average opinion to be. And there are some, I believe, who practice the 4th, 5th, and higher degrees. That would take going into credit default swaps and synthetic CDOs and stuff like that. But we are looking at things, I think, in a dangerous way. Puggy Pearson. Pug's an interesting guy. And only 3 things you need to know, keys to success. Knowing the 60-40 end of a proposition, money management, and knowing yourself. Any donkey knows that. Now, to make things even worse, Puggy quit school in 7th grade and went to Las Vegas. So he doesn't need any help, and is the winner of the World Series of Poker right there. Now, let me finish off and say that Lord Keynes and Puggy provide good advice for CFAs, whether you're on the buy side or the sell side. In this world of turbulence that I've described to you, Wall Street has, in the last 15 years, totally commoditized the business, every level, in effect. 2,000 order entries, for instance, there. You have new elites replacing the old ones. What comes to mind are private equity people, which basically have swamped Houston. Algo traders are doing very well, like and prop shops like Virtu Financial there. We've had this continued debasing of via aggressive trading and correlation of aggressive accounting and valuation. It's not peculiar just to oil and gas stocks. There are more potholes, I think, on the road ahead there. We've had 2 market crashes in the last 15 years there. And out of the dust or ashes, we've been commoditized there. There are no good roadmaps ahead either, to help us navigate these potholes. Investor confidence is not exactly buoyant. We're all kind of whistling in the dark. We love the market going up 32% a year. We can take that, no question asked there. So I close by asking you to really stop, look, and listen, to filter out all the noise that you see out there, to look through all this Regulation G and find out what the true values of these companies are. Maybe Thomas Watson of IBM, founder of IBM, said it well. He had his corporate motto was just think. Then Steve Jobs came along with his own motto, and that was think different. I'm not in their class by any means, but I simply tell you, think twice. Thank you very much. And I'll be glad to answer any questions if you have any. Or are you going to go easy on me? Yes, sir.
Are you any thoughts on MLPs, things to be looking at in that field?
MLPs, again, full disclosure, and I'm sorry I didn't mention another company, OneOak, but this is in the same kind of class. MLPs take care of you, they take care of their investors, as opposed to, say, oil service companies, which do just simply corporate buybacks and whatever. half my portfolio is in MLPs. Now, that's the good news. The bad news is there are always clouds over MLPs, and that is that maybe, just maybe, a Democratic Congress will take away their tax exemption or deferral, just like the Canadians did in the mid-1990s. That's a cloud. That's Republicans stay in harness in the House. I don't think that's going to happen, personally. The other problem, maybe even more so, is that if we were having this conversation about, 10 years ago, maybe a little more, we'd have had 30 MLPs. Now we've got 110 energy MLPs and counting. So it's a matter of shelf space. They're going to keep on coming and coming and coming. So what is a better MLP, a good MLP versus a bad one? I think the quality MLPs like Enterprise Products, Magellan, Sunoco Logistics, in particular, and I'm missing two or three others there, Buckeye especially comes to mind. The product pipeline MLPs and storage guys are going to be valued the best because they're no-brainers. It's just a total fee-based business there. The most interesting MLPs are the exploration and production MLPs, which are yielding 8, 9, 10% with hedges on, effectively. And those did very poorly last year. They were up a fraction, 2 or 3% all told. There's some which are very good at what they do, but that's something to keep your eye on. Coal MLPs, one just busted its distribution, NRP, Natural Resource Partners. And the gathering and NGL MLPs will probably do okay, but there's some takeover stories out there. New Star comes to mind, which is yielding about 8.5%, I think, right now. So, but again, it's a shelf space issue currently. I like the idea. I've grown old with a lot of these people there. So, let me say one other thought about ONEOK, because these people, never bought into all the Wall Street hype. The last 6 years, they've raised their dividend 17 times. Dividend as of last year was $1.52. Going out this year, the dividend is going to be $2.33. Okay, up and up and up and up. Just raised. If you'd bought the company 20 years ago, you'd have an average cost of about $2.50 a share now. Today, it's trading at 60. And they also dividended out just a couple of weeks ago ONEOK, or One Gas, which is their local gas distribution company. That's trading at 33. And you would have gotten, one share of One Gas for every one quarter of a share of One Gas for every share of ONEOK. So they took care of their investors, and the stock has been an absolute home run, 4-bagger, 15-bagger, whatever you want to call it, because they did that. Companies who buy back stock take care of their employees more than anything else, and because they're all, and you get almost $500 billion a year of corporate buybacks going on. But if you look at the proxy statements and you see that management is incentivized by higher earnings per share, if you have a lower denominator and flat earnings, your earnings per share keep on going up. And in 2012, that added about 20% to the earnings per share of growth rate of the S&P 500, for instance. I don't know what it did in 2013. So, any other questions, ma'am?
John, this was a pretty depressing talk to me. Do you have any prescriptions for us, or for Wall Street, and maybe for the CFA community or society?
Yeah.
To improve this dismal situation?
I'm a pessimist right now, I have to tell you. Obviously, I'm a pessimist. My lovely bride, my wife and I were on a trip a few months back, and we heard the definition of a pessimist was simply that you're a better informed optimist, effectively. That comes from a stand-up comedian in Budapest, so if it works for him, it works for me. I think we need a fair way. We have this entirely wide open 23 different ways to value a company in the exploration production business, and I don't know how many ways that you do with Facebook and companies like that. But I think if you go for the jugular, when I'm, with the old kosher, classic Graham and Dodd approach, does this company make money? Does it pay out dividends or whatever? I won't buy a stock without a dividend on it, because I'm taking all the downside risk. The management has no risk. Management writing itself options left and right. I come from, again, I'm a hardened sinner. I spent 35 years thinking exactly the opposite until I got on the other side of the table and say, wait a minute, I'm getting screwed by these people. And I've seen many people in Houston, CEOs and whatever, tell me that paying dividends is tax inefficient, that they can do better with the funds. My response is, I want the money, okay? I don't care. I'll pay the taxes. Sooner or later, I'll have to pay taxes anyway. If you simply, using what kind of price-earnings ratio can buy, what kind of growth rates, yield, profitability, and whatever, that'll keep you out of trouble. It'll keep you honest. If you want to buy a Twitter, go down that deal and won't pass the laugh test, I have to say. So you won't buy it. It'll keep you out of trouble. You may miss a lot of upside, but you miss the downside. We found out when we ran our hedge funds, our 3 hedge funds, that people don't care if you don't make that much money, but if you lose money, they're all over you, with a whip, effectively. So buy good yielding stocks, MLPs, and just grow along with them. And secondly, you can, in trading markets that we've been in, like the last 5 years, you always use limit orders, and you can write call options and whatever else, and add to your your kitty that way. Ma'am.
May I follow up on the MLPs? At another CFA conference held in Houston in November, some people in the energy business spoke. The MLP dividend is really a return of your own capital for 5 to 10 years, so I don't know that it's really earning anything. Speak to that.
That is a very good question and very good statement, really. I agree with you. It is a return of capital. It is a tax deferral and so forth. The trouble is, in a zero interest rate environment, those kind of numbers keep on going up. The distributions keep on going up. And this has been a happy home for retail investors in particular. AMLP, which you couldn't see on the correlation there, that is a C Corp. It's the ETF for MLPs. And you get a 6% yield on that, and that's with a tax effect taken out. So you can solve that particular problem with AMLP as it goes. But your point is very valid. MLPs were the best asset class you could be in from the year 2000 to the year 2011. Outperformed everything else, commodities, gold, whatever, So,
Thank you so much, Don.
thank you very much.
What can we get for you?
Oh, good. Thank you.